Investment thesis: U-Haul, UHAL, at a cyclical inflection point. U-Haul is currently at a cyclical trough with a clear path to a 50 to 100% stock price increase. While the stock has underperformed due to falling moving earnings and aggressive growth capex, the outlook is shifting toward improved returns and stabilizing macro conditions. 1. The opportunity, valuation, and upside. Current valuation: trading at 9 to 11 times normalized economic EPS, $4.20 to $5. Adjusted multiple: excluding $7 per share spent on non-active storage development, the stock trades at roughly 8 to 9 times. Downside protection: trading at 1.15 times book value, near COVID-era lows. The free business: self-storage assets nearly cover the current enterprise value, EV, meaning investors are getting the dominant moving business essentially for free. 2. Key drivers for a rebound. A. Moving segment recovery, $1.70 to $2.45 EPS gain. Macro inflection: existing home sales and equipment rental revenue are at a trough but starting to pick up as mortgage rates stabilize and home prices moderate. Competitive edge: competitors like Penske and Budget are shrinking fleets, allowing U-Haul to gain market share. Operating leverage: a return to the historical 7% EBIT return on gross fleet assets would add $2.45 to EPS. B. Normalizing fleet costs, $0.70 EPS gain. Lower capex: recent cargo van prices are down 20% from their peak. End of accounting noise: high depreciation and losses on vehicle sales have weighed on recent earnings. As resale markets stabilize and the fleet is refreshed with cheaper units, depreciation is expected to revert to the 8.5% historical average. C. Self-storage maturity, $0.90 EPS gain. Embedded growth: U-Haul has maintained a 10% CAGR in storage square footage for 20 years. Stabilization: there is $283 million in embedded revenue as newer facilities reach 90% occupancy, carrying high incremental margins, 80% plus. 3. Strategic shift: focusing on cash flow management is pivoting from aggressive expansion to harvesting value. Capex cuts: real estate and fleet spending are being reduced by 20 to 40%. Insurance dividend: the overcapitalized P&C subsidiary recently paid a $100 million dividend to the parent, signaling a new focus on extracting value. Management alignment: CEO Joe Schoen, 76, who owns a massive stake, recently expressed a desire to see the business lay some golden eggs after years of heavy reinvestment. 4. Valuation summary and targets: the projected upside to $68 to $92 per share is based on a sum of the parts (SOTP) analysis. Existing storage facilities are valued at 16 to 17 times EBITDA, a discount to peers, while the moving fleet is valued at 1.0 to 1.5 times net book value. This implies a consolidated multiple of 15 to 17 times normal economic EPS, which sits well within the stock's historical trading range. 5. Risks to monitor. Macro sensitivity: a slower recovery in housing turnover could delay the moving segment's rebound. Storage occupancy: high interest rates and weaker street rates could impact the timeline for hitting 90% occupancy in newer facilities. Management horizon: Joe Schoen manages for the long term and avoids short-term financial engineering, which requires investor patience. Conclusion: U-Haul offers a rare combination of a dominant market leader at a cyclical low, backed by massive real estate value, and a management team finally shifting toward cash flow generation.